Nicholas Bornolis of Capital Inc. I would like to welcome you to this panel. The discussion on this panel is going to focus on alternatives and real assets. And we are going to have a discussion on REITs, MLPs, preferreds, and convertibles. And before turning the floor over to Alex Reiss from Stifel, Alex is also part of our advisory committee. I would like to thank each one of you for your participation. One of the things that I mentioned in the opening remarks today is that one of the great things that we have been able to develop and enjoy during this 20-year period that we're hosting this event is a great group of supporters who year after year help us to put together a great event in terms of content. And thank you again for your support and contribution and sponsorship. So Alex, the floor is yours. Thank you again.
Great, thank you very much. Before we start, I would also like to extend a thanks to Nicholas and his team. This is a very complicated affair, and they do a lot of work behind the scenes to make it all come together as smooth as it does. This conference, I'm sure everybody has been finding it, as I have, interesting and engaging as usual. But with that, we unfortunately only have 40 minutes today for what is a very current and applicable topic, and I'm sure very few people showed up to hear me. We have 4 exceptionally experienced panelists for our discussion today for alternative and real assets. First, Barry Nelson, who is one of the partners and now senior advisor at Advent Capital Management. Barry probably taught me more than anybody else that I know about convertible bonds, and I doubt that I'm the only person on Wall Street that can say that. We have Ryan Sullivan, who's the co-head of real assets at Aberdeen. Matt Sallee, who is a senior managing director and senior portfolio manager at Tortoise. He brings deep experience to energy and MLP investing. And also Paulo Almeida, who is the chief investment officer at Tufton Investment Management. He also has deep experience in the shipping industry and insight into investing in alternative assets. I'm sure we will have plenty of questions that come from the floor. We will address those as the presentations continue. And I also have a few of my own at the end. So with that, I'll turn it over to Barry and let's get started.
Gosh, Alex, thanks for those kind remarks. And you've done a great job in an odd field, closed-end fund research, not enough research into this type of security. But here we are to enlighten the listeners. Convertibles, the nature of convertibles, the concept of capturing equity-like returns over time because of the tendency for convertibles to capture most of the upside of the underlying common stocks while having excellent downside protection. And these characteristics seem to me, and I'm prejudiced, to be especially timely right now. I mean, we're worried about inflation, and convertibles offer equity sensitivity. The value of companies ought to go up with inflation. If inflation or rising interest rates ensue, that can pressure PE multiples, yet the record shows over the last 20 years, when there have been periods of increases in the interest rate on the 10-year treasury, that convertibles have usually gone up and have consistently outperformed all other fixed income asset classes. Yields are low in all of our asset classes these days, but in convertibles, at least we do have mandatory convertibles, which provide their asymmetry essentially by having much higher yields than the underlying stocks. And of course, whatever's coming with taper, rising interest rates, God knows, higher volatility increases the theoretical value of convertibles and creates trading opportunities. And we're in a period in the wake of record issuance of new convertibles in the US last year and continuing this year, gives us lots more opportunities. Tech, consumer, healthcare, those are dominant sectors that all have favorable prospects at the moment. Growth are us among convertible issuers, and that's been the place to be. And I've talked as fast as I can. Alex, you are on mute.
I am unmuted. Sorry, that is a fail for the moderator. Thank you very much for that introduction. I'm sure there's going to be a lot that we'll get into, but I think Ryan is going to go next. We'll do some of the prepared remarks, and then we'll kind of gather questions at the end.
Great. Thanks, Alex, and thanks everyone for joining today. So as Alex mentioned, I am the co-head of real assets at abrdn. I spend the majority of my time on the global infrastructure space. I help manage a closed-end fund in that space that actually spans both the public and the private markets. I actually spend the majority of my time on the private side of things, and so wanted to kind of provide some high-level commentary there. But maybe just as a starting point, I think one interesting note about the closed-end fund structure is the ability to put in private, more illiquid investments into the vehicle. Again, you don't have to worry about the capital inflows and outflows. So the fact that the closed-end fund structure is a permanent pool of capital that can ultimately support more illiquid types of investments, we think is particularly unique. And it's particularly unique as you look at the global infrastructure space for a variety of reasons. I think first and foremost, there's been obviously a lot of capital attracted into the space, but the private markets can be a bit more inefficient than on the public side of things. That inefficiency, if you invest in a thoughtful way, can lead to a slightly higher yield profile. So as investors continue to think about this low yield environment, we believe both public and private infrastructure assets can do a great job in generating that amount of yield. And if you're willing and have the ability to take on the illiquid nature of some of these private infrastructure investment opportunities, it can be a real contributor towards that. I think the other thing that we've thought a lot about, and not too surprisingly, is just the increasing prospects of inflation. And Barry mentioned it earlier, but infrastructure historically has been a very good inflation hedge as well. On the private infrastructure side, we're typically looking at assets that have very directly linked inflation income streams. So owning a particular asset that will step up with inflation over time, we think that's critically important. And again, is really a unique attribute of the broader infrastructure landscape. Like the final point I was going to talk about is just kind of where we are in the global infrastructure space, again, at a high level. Lots of headlines in the space. It's very, very topical from a political standpoint. But as we step back and look at things, there's really kind of two halves to infrastructure as we see it today. On one side, you have some of the higher growth infrastructure sectors. These would be areas like renewable power, communications infrastructure, certain segments of the water infrastructure landscape. A key reason for that is there's a lot of decentralization going on, right? Renewables is probably the best example, where we're going from centralized kind of coal-fired power plants as an example to a very decentralized wind and solar and other types of technologies on the renewable side. And so we think that presents some really unique investment opportunities across both the public and private landscape. And then the second half is more of your kind of stable kind of elements of infrastructure, right? Historically, these were things like bridges and toll roads. Again, obviously, notwithstanding some of the COVID impacts, those continue to be high quality, high barrier to entry types of assets, importantly with those inflation linkages. So again, really looking forward to today's discussion, and hopefully that at least sets the table a little bit on where I focus and the things that we think about in the global infrastructure space.
Well, thank you very much for that, Ryan. And now on to Matt for a bit. Matt, can you just give us a little bit of background on what Tortoise is working on right now and some of the different aspects in the MLP world that you can come up to speed on?
Yeah, I think most people view Tortoise as an MLP shop, but in reality, I mean, that is our roots, but developed quite a bit of capabilities over the last decade. So basically, we're focused on broadly infrastructure, but energy infrastructure, and within that we include midstream, like I said, most people know us for, but also power and renewables, and kind of broadly we refer to this as decarbonizing infrastructure. So there's a lot going on to kind of meet the world's needs for more energy but less carbon in the future, and we can do this in public and private formats. So we've built out a lot of capabilities really to invest in not just kind of traditional energy infrastructure as people think about it, but renewable fuels and wind and solar, again, both in public and private formats. And we think we don't think there is a lot obviously going on in the world of energy. when you think about how do you continue to supply the world's energy needs, but do so with less carbon in the future, I think the one that people think about most clearly, that's most understandable, is decarbonizing power infrastructure. So basically replacing coal with gas and renewables. And that's creating tremendous opportunities and, a lot of investment needed, and presents years of visible cash flow growth for the power sector. And as you think about midstream energy infrastructure, they're also part of the solution, which I think people don't necessarily, recognize that these companies are doing, have made net zero commitments. So majority of our portfolios made net zero commitments, and is also significantly addressing the methane emissions that have been, a black eye for the natural gas space. So really kind of cleaning up their operations, but also investing in renewable fuels and carbon capture, which is a $3.5 trillion total addressable market. And I think it's pretty clear when you see what's going on in Western Europe or China that you really need an all the above approach to keep the lights on, but do so with less carbon. And that's creating a tremendous opportunity, and where we're particularly focused on in infrastructure. And certainly there's a positive tailwind from inflation and strong commodity prices and all those things going on in the space right now. So we're pretty excited about the future, in particular relative to kind of the last 5 years of poor performance.
Excellent. Thank you very much for that. I would like to also turn to Paulo, who has deep experience in shipping. Reading in his bio, a truly extraordinary resource that we have in front of us. And I can sort of speak for myself and say I know less about the shipping business and I know less about the investment opportunities there. So without further ado, Paulo, please.
Yeah, thanks, Alex. So I'm the CIO of Tufton Investment Management. We are headquartered in London. In addition to managing about $900 million in private funds for European institutions, we have a London-listed fund. Although it is listed in London, it is quoted in dollars, called Tufton Oceanic Assets. Got a market cap of just under 400 million. We listed nearly four years ago. What we've done, first privately and then in the public space, is to bring to institutional investors a real asset class that has historically been very difficult to access. It's a market that roughly is worth about $1 trillion in terms of ships that are of what we call commercially important vessels that we track on a global basis that move goods around the world, which a lot of people seem to very much take for granted until we have issues like COVID, we have issues like the Ever Given, and then we had clearly a lot of supply chain issues lately, and also just before the global financial crisis. Clearly, it's an asset class that's been around for a very long time, historically dominated by a few large listed companies and also families. Over the past 10 or 20 years, shipping tends to be behind aviation or aircraft leasing by about 10 years and behind real estate by about 20, 30, 40 years. It's gone from being a business that was dominated by a number of families, some actually quite small, into one where institutional capital has come into over time, and we've helped make it accessible. The asset class is interesting. We believe, and clearly our investors believe, it produces quite attractive yields on our portfolios over the past 7 or 8 years, although some of them have been not particularly good markets for parts of the shipping industry. We've produced low teens unlevered cash on cash returns fairly consistently. We've seen a lot of capital appreciation over the past year or so, and we've done so in a fairly risk-averse way, which is to invest across the 3 main segments of shipping, which have low correlations with each other, with low leverage, and by taking a limited amount of spot or merchant business risk, but putting most of our charters, most of our ships on medium-term charters of about 3 years. So most of our funds have about 3 years of cash flow visibility. We think shipping even becomes more interesting for investors over the next few years, because shipping, like some of the asset classes that other panelists have mentioned, historically has been a very good inflation hedge.
Well, anyway, thank you very much for that. We are getting a few questions that are coming in from the field. I'm sure there are going to be a few more, but I just wanted to start. We've done this panel many years, and Barry and I have been on panels several times. And it just seems that with the market that we had in 2020 and how well convertibles did, many funds, including Advent's, performed remarkably well. So a couple of questions. First of all, do you think that convertibles are really entering the mainstream in a way that they sort of hadn't before? Do you still belong on the alternatives panel because of how well they've done and how well people are integrating them? And also then, just as one follow-on question for investors that have yet to really integrate convertibles into their portfolio work, but have a more traditional 60-40 mindset, what advice do you have for them when it comes to starting to make investments in this space?
Gosh, if I can tackle the concept of whether we are still alternatives, I'd say convertibles never enter the mainstream. I mean, we've studied them going back nearly 200 years in the US, and there were also some in earlier centuries, even 300 years ago. It's always a niche. It would be a miracle if we became mainstream. So I sure wouldn't bet on that, although convertibles are certainly enjoying a very good run of new issuance, which happens periodically. Market never goes away, but sometimes issuance slows down. Sometimes it speeds up, and we've been in a speed up in the last year and a half. Regarding the typical 60-40 balance between equities and fixed income, we see convertibles as akin to an automatic transmission. That is, convertibles become more equity sensitive when the underlying stocks go up, and convertibles become more bond-like if the underlying stocks go down. So in essence, convertibles are always providing a sort of an automatic reallocation as opposed to what is necessary if a portfolio starts out 60% equities and 40% fixed income, and at some point annually or whenever, it has to be rebalanced. And I think we all know almost everybody drives an automatic car, and automatics do work better than stick shifts. You get better mileage, and I think the record shows that we get better mileage with convertible securities.
That's very interesting, and I think the more that I have learned about the asset class and had a chance to now watch it for 15 years, 20 years, that is true. I had a question. My next question is for Ryan, and maybe also Paulo, if you want to jump in. Ryan, I know that you would focus on the private real estate space, and you've given us some view of the public versus private opportunities that are available in real assets. Can you explore about how investors should think about investing across liquid or illiquid investments, and again, with a nod towards portfolio construction and how to integrate these alternatives into a more traditional portfolio?
Yeah, Alex, it's a really great question, because as we engage with clients, that is typically the question a lot of people are asking, right? What is the right mix between public and private? And listen, I do think it speaks to each individual or institution and their liquidity tolerance and ultimately what their longer term kind of goals are. But I think level setting that a little bit, there's a couple things that we think a lot about as we think about public versus private. First and foremost is there's absolutely no reason to be in the private markets if you're not going to get any sort of alpha or illiquidity premium or whatever you want to call it. So we do think that regardless of whether it's within a closed-end fund wrapper or just broader portfolio construction, every single private investment opportunity that we look at, we compare it to the public markets, right? And we say, hey, if there's a really interesting communication infrastructure asset that we're looking for, but we can buy a stock in the public markets at a cheaper level, why wouldn't you do that, right? Because you can it's more liquid and you can buy and sell out of it. So that's a really important framework that we think about. there has been a lot of capital raised into the private infrastructure space, right? The private infrastructure universe is much, much larger than the public infrastructure side of things. And as a result of that, there are times when some of the typically very large transactions will go off at a multiple much, much higher than where the publics are trading. And from our standpoint and how we approach the space, that doesn't really make sense, right? You should really be thinking about where is there an attractive entry point in the private markets that can really complement the public side of things. And so private investing is obviously harder. It's much more resource intensive. It's very bottom up in nature. But we do believe and have found some unique opportunities where you can go into a very inefficient and fragmented market and ultimately acquire some assets or have a business plan to build out a portfolio at a lower valuation. And ultimately, that can be a very nice complement to what you have on the public side of things. We think that the private should outperform publics by anywhere from 3 to 5% on a long-term basis. But it's much more fundamental than that you need to think about every single investment coming at it from a bottom-up side of things on the private infrastructure side of things. And then my ultimate hedged answer is we do believe it's important to have a little bit of both, right? We wouldn't necessarily advocate for all of one or all the other for a variety of reasons. But I importantly think that framework and structure is critical to think about when at least starting to deploy capital into the private infrastructure space.
That's very interesting. Yeah, and again, maybe just turn the question over to Paulo, because investments in the shipping arena for many U.S. investors are a really new concept. Yeah, just a little bit about integrating it and thoughts on liquidity and illiquidity in those kinds of different environments.
Sure. Well, there have been times where the shipping stocks have been, and I think, the past few months, the U.S. shipping stocks have been potentially a quite interesting and liquid place. Lots of news flow. Although we can't say that about much of the past 30 years, other than perhaps the 2004-05 to 2007-08 period, where on the back of primarily very strong growth in China, where shipping sort of became a darling asset class for a few years. But clearly the valuations and liquidity have been very volatile. They sort of go step in step. They work together in that market, and even now, after the performance that the shipping markets have seen over the past few years, the market cap of the whole New York listed shipping industry, will be far less than it was in 2007, 2008. So we access it essentially through a private strategy, which we think is the right way if you are looking for the cash flows, the diversification, and the real asset aspects of shipping. If you want to take a bet on a specific segment with very high operating leverage and high financial leverage, that's traditionally hedge funds have done, which are not a target investor of ours, but hedge funds have been very big investors in these New York and to some listed shipping companies in the past. Now, whether you access that through private, you access an underlying private strategy through a private fund or through a public fund, that really comes down to philosophy of the investor, which we can't dictate, but also ticket size. So the strategies that we run for a few European institutions, each of those portfolios is between 250 and about $400 million. There aren't that many investors who have that much capital to put to work in shipping. So we have a $400 million or so listed vehicle, where we have a few investors who own about 10% of it. We have a few that own about 5% of it. And of course, just like every other listed company, we have a long tail of investors, and we love them all, not just the big and medium-sized ones. So this is a way for institutions, so smaller pension funds, charities, endowments, and high net worth individuals to access shipping through this risk-averse strategy that otherwise is very difficult to access unless you can write a very, very big ticket.
Right. Fascinating. I have one more question, and this one's for Matt. Energy infrastructure has just had a bang up year. By one measure, the Alerian index, I think, is up 85% in the 1 year period, which has just been obviously fantastic. And you can just see that the flows are following. But so two questions. First, sort of like, where do we go from here? What's your prognosis on this fascinating market? And also, again, how do you think, again, from the perspective of an individual investor, how do you go about negotiating the volatility that comes with energy infrastructure and, again, portfolio integration?
Yeah, so yes, the 1 year numbers have been pretty good, but you have to kind of consider the starting place. And obviously, 2021 has been a lot more fun for me than 2020 was. It was absolutely, really difficult year. And if you just think about midstream energy infrastructure over the last 5 years, kind of leading up to the pandemic, these companies were investing over $70 billion a year to try and keep up with U.S. shale production growth, generating significant negative free cash flow, misalignment between management teams and their investors. The global crude market was oversupplied. Midstream was paying up to, midstream public companies were paying up to buy assets from private equity. And 2020 kind of reset all that. It was incredibly painful. However, U.S. production growth has took a step back and has now kind of leveled off. So there's not a lot of need for additional investment. So as we look forward, there's enormous free cash flow that these companies are generating, because the cash flows, even during the pandemic, fell by a few percent. So the stock prices were down, 65% at one point. The cash flows were still there, and there was a lot of technical factors driving that. As we look forward, if you look at the free cash flow generation of the space over the next, just inside of 10 years, it's greater than the market cap of the space. So I think that does a couple of things. Number one, it allows management teams to deleverage if they need to, and that we're largely kind of through that, but pay, stable and somewhat growing dividends, but then buy back stock, because the stock prices, basically, if you look at a cash flow yield of the equities, they're trading in the mid-teens. So it's hard to find a capital project that's going to have returns, higher than effectively a guaranteed mid-teens sort of IRR. So we're really encouraging management teams to buy back stock. That is happening, and I think that's part of the reason that the space has rebounded, along with a lot of macro factors. Inflation's great for the space. Commodity prices are tight, are high. If you look at just we've had basically 5 years of underinvestment in new oil and gas supply, and as we come out of, certainly that was really exacerbated in 2020. And we're coming out of that, and demand is off the charts. Gasoline demand basically at an all-time high. Natural gas demand's well above any previous levels, and there's not enough supply to meet that. So that sets up really well from a macro standpoint for the space, providing a nice tailwind. On top of that, these companies the public companies are now selling assets to private equity at multiples that are higher than where the public markets are trading at, which is as we talked about previously, it doesn't make sense. And then the last thing I will mention, or failed to mention, I should conclude with, is energy companies have been very resistant to energy transition and decarbonizing. That has changed 180 degrees. And if you just look at all, just over the last, basically in the third quarter, all the different announcements that have come out from midstream energy companies and things they're doing to invest in renewable natural gas, renewable diesel, starting to invest in hydrogen, partnering with renewable companies. There's just a lot of exciting things going on. But I think underlying all that is capital discipline that will help drive returns, for the foreseeable future, on top of a really good macro setup.
Good, very good. Interesting all around. We have a couple of questions coming from the audience. The first one is directed to Barry. The questioner says it has two parts to the question. Noting that a lot of the closed-end funds that invest in convertibles utilize some leverage, they have a two-part question. One, in terms of the rising borrowing cost and what that might do to fund performance. Also then leading into an inflationary environment. What do convertibles do if you're in a period where inflation runs above average? Barry, I think you're muted.
Okay, well, then I can correct any blunders I made in my first remark. Anyway, it's obvious that rising cost of leverage is a negative. As long as our returns are favorable, though, we will still tend to benefit from leverage. We also have the flexibility to deleverage. And of course, we have the flexibility to hedge against rising rates. So it isn't an open and shut case that rising rates necessarily will result in unfavorable returns. In terms of inflation, I would say that history shows that convertibles did very well in the second half of the 1970s and in the 1980s, when we had high inflation, and perhaps worse, we had the stagflation that we all worry about recurring right now. And that was it was a glorious period for convertibles. And I've been on the street since 1972. I have a vivid recollection of it. It was a bad time in general, but it was a good time for convertibles.
Right, and I think that also speaks to some of the advantages of these actively managed portfolios, where as dynamics change, there are real professionals here with a lot of experience that manage these products, and yes, they do try to adapt to conditions as we find them. We have another very interesting question that's sort of touched on from the audience, and I think this one's primarily for Ryan. The question really went to the definition of decarbonization. And when you look at infrastructure assets, obviously there's going to be a lot of panels today that mention ESG, and I think a lot of these definitions really sort of have to get tightened up. So when you speak about decarbonization and some of the opportunities that are available at Aberdeen, can you give us a little bit of clarity on that?
Yeah, sure, Alex. And so I think you're absolutely right that the definition needs to get a little tighter, and people will still think of decarbonization in lots of different ways. But as we step back and think about it, and it relates to our underlying investment strategy, there's kind of two halves to decarbonization as we see it. The first is to decarbonize the electricity grid, right? So this is very well defined at this point, right? You can replace a coal-fired power plant with wind and solar. And then the second order to that is try and electrify as much as you can, right? So go from a conventional kind of gasoline-fired car to electric vehicles, right? You can kind of force houses and businesses to heat through electricity versus fuels. And so that element of the decarbonization, in our view, started really back in the kind of early 2010 timeframe, right? Where you see a lot of subsidies move into the renewable space. And solar and wind back then wasn't very cost competitive. Today it is, because it's been subsidized for a long period of time. There's been some great technological advancements. I think the second half of the decarbonization story, and Matt actually touched on it, is more on the fuel side of things, right? So if you can also think about decarbonizing the fuel set and going from, for example, conventional natural gas to renewable natural gas, that's another critical element of the decarbonization story, right? Very similar on the renewable diesel side of things, right? If you can replace that with something with a more renewabilized feedstock, that is a critical element to decarbonization. And I would also add into that carbon capture. So those are kind of newer areas of the infrastructure space, right? As you think about renewable natural gas, carbon capture, there's new technologies coming into the market. Typically, there's a bit higher cost from an operating standpoint. But the other thing that we're spending a lot of time thinking about is the emergence of the carbon credits market, and how does the carbon credits market interact with owning the underlying infrastructure, right? Because if you really think about it, if you own a renewable natural gas facility, you're not only selling natural gas, you're also having the income stream from the carbon credits side of things. And so how do you hedge that out? How do people think about that? Will there be corporations that will enter into long-term inflation-linked contracts, for example, that relate to the underlying infrastructure, which is what we're trying to do, right? Root a broad global portfolio in high-quality assets that are essential in nature, and importantly, have that inflation linkage. So there's a lot to the decarbonization definition, but if you think about those two broad halves, the renewabilization of everything on the electricity side is much more well-defined today. I think the fuels carbon capture piece is something that's going to be very interesting to watch moving forward.
Oh, thank you very much for that. That's actually very interesting. I think it really prompts a follow-on question that I have for Paulo and maybe also for Matt. Paulo, I know that in the shipping world this past year, there was a major issue in terms of transitioning fuels to lower sulfur contents and all these other things. Do you have anything to follow on about what Ryan is saying about, the electrification of many things has sort of happened now for a long time. It's been ongoing, but this move towards regulating fuels and thinking about that, how do you look at that with an expertise in the shipping industry?
Sure. Decarbonization of shipping is, as we just made a public statement about it a couple of weeks ago during Climate Week. We were one of only about 20 shipping companies and investors in the world to commit to invest in zero carbon capable ships before 2030 and to fully decarb. And a few more companies as well have a very important but also slightly less ambitious target of going zero carbon by 2050. So we all know, I think most people believe the world has to and will get to zero carbon by 2050, but we strongly believe that unless we do take significant steps before 2030, it's much more difficult to get to 2050. Before going into a few more things on that, just Ryan mentioned renewable diesel. As it so happens, around the same time, we ran a ship, which a few other people have done as well, but we're probably one of the first 5 or so to have run a full voyage of a couple of weeks fully on renewable diesel. So we ran it on a voyage from Europe to the Great Lakes and back, where the fuel is recycled cooking oil. So I don't know actually to the extent that you see this in the US, but it's pretty significant in Europe, also given that we probably use more diesel than in the US, but there are more and more buses and trucks that use recycled cooking oil, which means it's fully renewable. You're not growing plants just to make the diesel. You're actually recycling something that otherwise would go to waste, rot, and then release carbon dioxide. As I said, we committed to start investing in zero carbon capable ships before 2030. A very famous lawyer from within the shipping industry came in last week and asked me, what our plan is for that. Clearly there is a plan, but I told him it's a little bit like getting married. It's something you do once in your life. You don't have all the answers, but you think you have a lot of the answers, and you're committed to getting there in the long term. The technology is there, and we are prepared to put capital to work where we can share risks with other people in the industry. So if if IKEA, as it already does, IKEA's customers are pushing IKEA to reduce its carbon footprint. IKEA obviously needs to transport a lot of things around the world to its stores. They press the shipping companies to reduce their carbon footprint. The shipping companies need partners like Tufton, whether a listed fund or private funds, to provide them with assets that are capable of burning those green fuels. They take some of the risks in terms of they have to source the fuels, because it's the shipping companies that pay for the fuel ultimately. Just like if American Airlines leases a plane from what used to be GE Capital, it's not GE Capital that buys the fuel, it's American Airlines, it's our customers that buy the fuel. They take the sourcing risk on it, but we spend the money on the vessels in order that they can burn those green fuels. And this is going to be a very fascinating area over the next 3, 5, 7 years.
Very interesting. Maybe one last question. I know we only have about a minute left, but Matt, can you address some of the issues around the carbon credits and other things that Ryan had touched on?
Yeah, Ryan mentioned the carbon credits on renewable natural gas are an important revenue stream. They're 80 or 90% of the revenue stream, depending on the source, whether it comes from landfill versus dairy waste. The dairy waste can create significant negative carbon emissions, which has a ton of value for that gas. So we're seeing companies like Kinder Morgan have actually bought a company that is a producer of renewable natural gas, and they're expanding that business pretty rapidly. And we think that gas, we're virtually certain that gas is going to have significantly more value than fossil natural gas, because corporates like Microsoft, if you're trying to get to net zero, investing or purchasing negative emission fuels is far more effective than, putting renewables on your building, which help us, avoid carbon emissions. When you talk about renewable natural gas, again, depending on the source, you can get into significant negative emissions. So I think these are really powerful tools that traditional energy companies are bringing to part of the decarbonization solution.
Wonderful. Thank you so much, everybody. I think we have officially run out of time, but this is a fascinating discussion, and I really thank you all for your participation. Nicholas, thank you too.
Well, I will close the session by simply saying thank you very much. Indeed, a very insightful and interesting discussion. Thank you very, very much.
Thank you.
Thank you.